All right. I got an important question for everybody watching right now. Who's ready for Kraken Kingdom, baby? Holy Toledo! I'm not supposed to hit my chest, I'm sorry. Let me just put this back really quick. Anywho. What is up, everybody? Welcome to Trey's Trades, where we freaking talk fast and don't skip class, baby. Like we preface by saying that I'm not a financial advisor nor expert, so take what I say with a grain of salt. Let's get into the video. So today, my friends, my family, my fellow Gorilla Gang, I want to talk about the short situation, right? Specifically speaking on the opportunities that they've had to cover their positions for a very long time. I think on a Sunday morning, it's a great opportunity to discuss really truthfully how crazy the situation is and how far the apes have come to get where we're sitting right now. So we're going to go over reverse repos because I think this is actually going to show you a really holistic picture on how systemic this whole issue is, and that AMC is a culmination of all the systemic problems, and malpractice that have taken place here in the stock market over the last couple of decades. I want to go over the Ortex data and show you the average days that shares have been on loan, the average short interest positions, right? And most importantly, just the opportunities that they've had to get out of their position and how much of a pride and ego play this really is, because these big pros, the smart money, have gotten outsmarted by the dumb money, the freaking apes, orangutans, silverbacks, the primates out there who have ended up making a good amount of cash and will make more to come. So with that being said, let's just start off here with reverse repos. So I'm going to walk you kind of through what this process is. If you don't know, it's actually a lot simpler than you think it is, right? But the Fed's reverse repos have hit historical numbers, $503 billion as of June 9th. Now check this out. I just want to show you this chart because this is a pretty interesting thing to see. Now you look at March 31st, 2020. You might think to yourself, okay, what would that spike have been? That was when COVID quarantine, the whole country just shut down here in the United States, right? That was when things went fucking crazy, right? The entire country, was slammed by economic issues. A lot of businesses shut their doors for months and months and months at a time. So it makes sense at that point in time for there to have been reverse repos, right? To essentially borrow money from the Feds, the Federal Reserve. You can think of essentially as this big, pool of cash that they borrowed from, right? And we're going to walk you through this whole process here in a second, but that makes sense. Then it dipped down to nothing. You had pretty much no reverse repos out on the market because this is meant for short-term securities, right? It's meant to make up for a lack of cash flow so that you can, basically supply the economic, situation and climate of the United States market, right? So it drops down to zero, and all of a sudden here, 2021, you have this huge historical spike up to over $500 billion of liquidity that's been borrowed out by the Feds. Now that is a huge number. And I'm going to kind of walk you through why this is so critical, right? So what's a reverse repo? To put this very simply, you can think of this as a short-term or a long-term loan. Typically, with these sort of dollar signs, you would want to take out a short-term loan because you don't want to accrue interest, right? Any sort of loan has an interest rate. You can think of as a cost to borrow liquidity, similar to what you'd see in the stock market, right? If a lender is lending out stock, there's a cost to borrow that's associated with whoever the lendee is that is borrowing from the lender, right? So here's two steps. It's as simple as this. The Feds in this situation have lended out money, right? This is a reverse repo. On the flip side, you have regular repos, right? And repos would be when the Feds are borrowing money, but reverse repo, they're lending out money, right? So you've got money that's been lended out by the Feds over to parties who are interested in borrowing cash. Why would they want to do this? Simple as it gets, right? There's no fucking crazy answer here. It's as simple as they don't have cash supply. They don't have enough money to sustain operations, and they're trying to essentially put a Band-Aid on whatever sort of cash problems they have, right? It makes sense back in March. There was a lot of economic problems. To do it now, that raises some questions. The country's reopening. Things are starting to look pretty good, right? The market is better than it's been since literally a year ago, right? There's a lot of great things that are happening in the U.S. economy right now, getting us closer to some sort of normality. So now that you've got that, lended out of the way, step one, they've lended out cash, and that goes out to institutions, right? Now they have to eventually return this plus whatever sort of interest they've accrued on their positions, right? So they return their loan and the Feds receive their money back. Simple as it gets. That's a reverse repo, right? Now let's just kind of look at this. This is what's really fascinating and intriguing to me is as of June 11th, you had $547 billion on reverse repos. Now look at this chart, right? You can think of this as a stock chart, essentially. It's the same sort of thing. When something goes up too much too fast, typically it pulls back. Something goes down too much too fast, typically it goes up. But what do you see here, right? What do you see here? You see an insane amount of parabolic growth in terms of lending that's coming out from these big institutions that are borrowing money from the feds, right? And I pulled this up because I think this is a great way to essentially give you the simple definition of what's happening here, right? Reverse repos are commonly used by businesses like lending institutions or investors to lend short-term capital to other businesses during cash flow issues. Now, why would there be any sort of cash flow issues for any sort of institution out there, right? The country's starting to reopen again. The stock market's doing better than it ever has before. A lot of things, on paper look absolutely fine. But that's the key here, is they're trying to make things look absolutely fine when in fact it is not, right? This is an ego and pride play, and for anybody to say otherwise is just a bunch of baloney. It doesn't make sense. And I'm going to tell you why this correlates with AMC stock, right? So $547 billion being lent out to big institutions and firms, right, to essentially put a band-aid on their short-term cash flow situation. Where's this money going? Well, you look at the stock market, you look at a lot of different securities in the stock market, such as AMC, BlackBerry, GameStop, COS, Bed Bath & Beyond. A lot of different stocks are being heavily shorted. The amount of money that's come into the stock market in the last 6 months is astronomical. Now, this has to do with two things. It has to do with the stimulus checks that have been printed out, right? New money that has been printed out by the feds, as well as reverse repos. Money getting pushed into the stock market that was not there before because it's borrowed capital. And what this ends up doing, my friends, is it gives you this false growth, right? So let's just look at the daily candles on the SPY. Since March, you had a beautiful, beautiful bounce back up. But this is the thing, right? With this sort of growth, how much of this is real? You have to wonder, right? And I'm going to tell you, probably not a lot of it. And that's for two main reasons. So you had a drop down in March to about $218 on the SPY to new all-time highs at about $424. But the problem with this is very simple, right? What's the problem? You have an inflated supply, right? Supply and demand. So what happens, right? You increase the amount of supply, which actually decreases the demand, but you don't see this on the charts because it hasn't been accounted for yet. So when you put new money into the stock market, there's more liquidity in the stock market that was essentially created, borrowed out, whatever it may be. This does not get taken into the equation is inflation, right? Inflation will inevitably happen, and a lot of the money that's getting put into the stock market, although it has helped the SPY, is going to bet against the economy, to short stocks, to naked short stocks, to try and bankrupt companies that big institutions thought would not pass COVID quarantine, right? This is the problem. Shorting stocks that you think might go bankrupt, that makes some sort of sense. I wouldn't partake, but that's just me. Shorting stocks to make them go bankrupt is an issue. And that's what you're seeing happen with the reverse repo market as it is right now. An insane amount of liquidity, and I guarantee you a lot of this is an AMC, GameStop, all these different heavily shorted stocks is getting cracked down on, and it's an ego play. They continue to borrow more and more liquidity, trying to dig themselves out of this hole. Well, this is what gets freaking awesome, my friends, is the feds are stepping back into it. Now, this is an article, a filing that came out from the Federal Reserve, which you can speak of as the feds, right? Federal Reserve statistical release came out on June 10th, 2021. As of this date, if you read through this whole filing right here, there's a piece of this that I find to be pretty fascinating, and it's right here. Check this out. Maturity distribution of securities, loans, and selected other assets and liabilities, June 9th, 2021. Well, guess what? If you read the fine print here, reverse repurchase agreements, repos, right? Reverse repos, you've got $720 billion that the feds are asking for. $720 billion within 15 days. Now that is huge amount of money. Now what does this mean, right? This likely means that the feds have lent out a crap ton of liquidity to different institutions and investors, the bigwigs, the smart money, right? Playing on house money, get out of here. You want to ding the retail investor for being stupid with their cash? You tell me this, is it smart to borrow $720 billion and short it into a stock that it might end up squeezing? Heck no, it makes no sense. I'll tell you what, if it makes no sense, it's because it probably shouldn't make any sense, and this makes no sense. $720 billion is what the feds are asking back for as of June 9th within 15 days. Now, this doesn't mean it's going to get returned 15 days exactly. It could happen anytime between that period of these 15 days from June 9th up until what would end up being the 24th. I'm not good at math, but I think that sounds right. June 24th. That's a lot of money. So the feds are asking for this cash back, and what happens, right? Well, in any sort of loan agreement, you obviously want to make money on that loan. So if these big institutions didn't end up making money on that loan, which if they're shorting different stocks in the market like AMC, GameStop, COS, BlackBerry, Bed Bath & Beyond, whatever it may be, they're in the hole. They're not making money. They're down on their money. So where are they going to come up with this stuff, right? Where do they have the $720 billion? Obviously, I don't have an answer for that. All we can do is speculate, right? But my hypothesis, and I think a pretty damn decent one, is if you look at AMC right now, right? This gives you the holistic picture on how shorts are doing in the market right now. Not good. They're down a lot of money. This is some more statistical information. Fact, right, that we can give you to have some sort of speculation as to what's going on. Look at this. The average length of a loan, as of right now in AMC stock, 54.39 days. Now, if they borrowed money from the Feds, right, a reverse repo through the Feds to essentially spot them some liquidity until things go well, we're just going to zoom back 2 months, right? So 2 months ago, right now the price is sitting at $49.40. June 11th, you look back on what would have been April 11th, that would mean that the majority of the capital for any sort of shares on loan right now would have come at an average price of about $9.50, less than $10 a share. Now, what does that mean? It would mean if you had a short position in AMC stock right now, you're down 400 to 500% on that short position. So what happens if they borrow this money from the Feds? What happens if this is a reverse repo, right? They're gonna get some freaking margin calls. I'm saying this right now. Margin calls are coming. We've been saying this forever. They're playing with money that they do not physically own, and they've had plenty of opportunity to get out of this play, man. They just have. The average length of a share on loan, right? Look at this. It's absurd. 54 days. They had all this time and it was trading sideways. All this time to just give up, to get out of the stock, to take their small L, to take their small gain, whatever it ended up being, and just move on. Admit, you know what? We tried. They squeezed us out back here in January, but we gave it our best run, right? We couldn't end up bankrupting this company. We had defeat. The apes beat us, whatever. But guess what? They didn't. Instead, they added to their positions, and the short interest continuously climbed. Right? Look at this. Estimated short interest of free float. Look back here on April 12th. What did you see? Not a covering effect. 16.97% estimated short interest of free float, according to about 85% of exchange reported data. Reported being the key word because that's all that we know. They just kept adding. They kept adding. It's a pride play, man. And that's why I'm not taking my freaking foot off the gas pedal no matter how long this takes, because that shows you how far these guys are willing to go. They're willing to have historical reverse repo numbers, right? Take out historical liquidity from the Federal Reserve to say, piss on you little guys. You are going down. We're going to wreck you. We're going to bankrupt this company. We're going to take all of your freaking money away. This is why the financial media puts out all these pieces saying, look, you guys were betting against you. You're dumb for investing in this. Most of these guys don't know what they're doing. They're playing the freaking derivatives market, which is options, right? They're going to lose their money. What happens when the music stops playing? Blah, blah, blah. Well, guess what? People have been paying attention to this for 6 months. And these are numbers. These are facts. There are people who are playing with money that do not have to beat you. What do you think of that? I'll tell you what I think of that. It means I'm not stepping off the gas pedal, man. There's so much more to come with AMC stock. The freaking excitement, the setup, the derivatives options market chain right now, all of these things are filthy. The end game is so dangerously close, my friends. I cannot be more excited about the way that this freaking storybook is being written. This is a hell of a legacy. I really do think there's going to be some historical stuff that happens. I said this months ago. I'll say it again. This is what I'm going to close out the video with. When AMC squeezes, right, and it actually hits its peak, it runs the way it's supposed to, the market's going to take a nosedive, because this sort of liquidity getting put into short stocks, right, shorting stocks is going to freaking wreck some havoc, man. I'm telling you. You're going to see the short again. All these heavily shorted stocks, when the margin calls come and people start covering, they have to return liquidity, or they're going to run up because you got to buy back your stock. What happens with their long positions, right? If an institution is short on one stock and long on another, and they have to make up for their liquidity and get out of these other stocks, they have to sell their longer positions, which pulls the market down. I think it's going to happen, man. I don't know when. I can't tell you when. I don't have a freaking crystal ball, but this is a setup. These are facts. These are numbers. These hedge funds are really playing a game, man. They're betting all of their life savings on double zeros at the roulette table, and I don't think they're going to win this battle. And that's what I've got for this video. So blah, blah, blah. I know host people, drop a like, consider subscribing. Whatever you want to do, my friends. Catch you on the next one. Much love and peace.